Yes, after client acceptance, we know how to work on background information. So I want to pick from background information. We did factors to consider before accepting an engagement. Factors to consider before accepting an engagement. I tend to believe by now we understand our background information. I believe we understand background information or client knowledge. Now, in this area, somebody asks you how to gather background information about your client, and about two, where to get that information. The source are sources of background information. So those are the two types of questions that can be said from this: how to gather the background information and the sources of background information. Then the next question that can be tested from that part is what it entails. That is, what are the matters to consider? Yes, matters to consider. Under background information or client knowledge. So by this far, I hope you can answer these three questions. If you can do so, trust me, you're good to go. You can work on factors before accepting an engagement. Then from there are some issues of planning. Planning is a big deal altogether. I know by now you understand planning. It entails what? Factors that you need to consider when you are doing your planning. Factors to consider during planning. I hope you are able to answer that question. Other than that, I hope you are able to answer other than factors to consider during planning. You should also be able to tell what is strategic planning, or sometimes exam will tell you just formulation of strategy. That is strategy formulation. All these are questions that can be tested in this area, and you should be able to apply yourself. So if I just want something, just try to conceptualize your mind, try to see, are you able to answer that question? If you're not able to answer that question, go back to your notes, go to the notes and work on that. And that's how you can prepare yourself for exam. Then from there, other than the background information, other than strategic planning, some will ask you stages during planning. Stages during planning. Something else also need to try to see whether you are able to answer that. Then from there, consider, are you able to confirm content of planning memo? Content of planning memo. I totally believe we worked on that content of planning memo. If we don't do so, let me just know so that you can work on that. But I totally believe we worked on content of planning memo. That's another area that you also need to equip yourself so well. Now, then from there, of course, we have the next area that you need to work on. But that again, I'll be bringing that in a different topic. That is how to gather the background information. Now, again, I also believe at some point you're able to understand setting of materiality. Setting materiality. And also under setting materiality, I hope you need to understand during your planning stage, what you need to do during your planning, when you gather evidence, and of course, when you are forming opinion. Try to check what you need to do when you are setting materiality. You set materiality on what during planning? You set materiality on what when you are gathering evidence? You set materiality on what when you are forming an opinion. Try to see whether you are able to work on that. Then from there, factors to consider, all the challenges during planning, challenges during planning, challenges during planning, challenges during planning. Try to see whether you are able to answer, and if you can answer all these, trust me, you are going to go in this topic. Now, without wasting time, I want to go to our today's engagement. I think today we are supposed to start with audit risk. We are supposed to start, no, not audit risk, but business risk. We are supposed to pick from a business risk. So business risk. Business risk. Now, when you talk of business risk, please note somewhere, because I don't remember whether I gave that definition on those notes that I gave you. Business risk, just note somewhere. Business risk. This refers to an event. Business risk. This refers to an event or activity. Refers to an event or activity that is likely to take place. That is likely to take place and affect the business negatively, and affect the business negatively, and affect the business negatively, hence affecting the going concern of the business, hence affecting the going concern of the business. I repeat, business risk, this refers to any event or activity that is likely to take place and affect our business negatively, hence affecting the going concern of the business. Now, that's what I want us to do today, and if possible, I want to see that we finish that area today, to decide that tomorrow probably we can work on audit risk, and that will be a good point to end the week in. Now, so business risk, we have said this refers to any event or activity that is likely to take place and affect the business negatively, hence affecting the going concern of the business. Now, we have 4 components of business risk. Components of business risk. Now, we have 4 components of business risk. Number 1, we have financial risk. Financial risk. Number 2, we have operational risk. Number 3, we have compliance risk. And number 4, we have external risk. So, if someone asks you components of business risk, please note, they are 4. Number 1, we have financial risk. Number 2, operational risk, compliance risk, and external risk. Remember, we have seen business risk, this refer. Yes, welcome, Annette, as well. It's okay, Annette, welcome. So we are working on business risk, Annette. We are working on business risk. And we have said business risk, this refers to any event or activity that is likely to take place and affect our business negatively, hence affecting the going concern of the business. And we have said we have 4 components of business risk. And please, I want you to listen keenly, because I know we are not going to put anything down, because I think I did send those notes. You are with them. Can someone confirm whether actually I did send notes on this part? Did I send those notes? Please, someone confirm. Just note there so that I can confirm. So, business risk, we have said, is any event or activity. Yes, thank you so much, Olivia. Any activity or event that's likely to take place and affect the business negatively, hence affecting the going concern of the business. Please, I want you to be attentive to this part. Meaning, by the end of the day, of course, I'll be taking through approaches that you are supposed to work on. And some of the things that need to come in your mind is the event that you have noted that there is element of business risk. Remember, part of the background information that we got when we are discussing background information, we say we need to work on the risks. Wherever we were evaluating, we said we have 2 forms of risk that you are likely to face. Number 1, you are likely to have element of business risk, which is a risk that affects the organization that you're auditing by the fact that they are existing in a given environment. Then number 2, we say we have on risk, whereby we say on this now, this is the risk that us as auditor, we are likely to incur if we give inappropriate auto opinion that the company has kept from books of account when actual sense they have not done so, or the policies organization has been adhered consistently, when actual sense that is not the case, or probably when we are like to tell people that we have received all the information and explanation deemed necessary for the purpose of forming an opinion. Then from there, I remember I did indicate that we have 3 components of audit risk and 4 components of business risk. Now, by the end of the day, you as an auditor, you need to confirm if I know that there is business risk, how is this likely to affect me as an auditor? How is it likely to affect my assignment? And of course, we'll see some questions in this area whereby some will ask you, if you know this element of business risk, what does it translate to you when it comes to formation of an opinion? There's some issues that we'll be able to see as we continue the discussion today. Meaning, as long as I've done my risk assessment and ICS, and I've noted there is element of business risk, then from that point, I need to develop element of professional skepticism. Please, someone note somewhere. Don't remember mention this time. Note somewhere professional skepticism. Just note somewhere in those private notes of yours. Professional skepticism. Now, professional skepticism, we are writing. This refers to the attitude. Professional skepticism. This refers to the attitude. This refers to the attitude of questioning mind. This refers to the attitude of questioning mind. Other books of equation. It is the attitude of questioning mind. It is the attitude of questioning mind that something is likely to be wrong. That something is likely to be wrong. In other words, we say professional skepticism is having the doubtful mind. Professional skepticism is having doubtful mind that something is likely to be wrong. Why is it important to you as an auditor? Professional skepticism helps you to increase your sample size and also consider the right audit technique that you're supposed to use. Meaning, by the fact that I've noted there is an element of business risk, then as an auditor, I need to draw an element of professional skepticism that something is likely to be wrong. Now, how will I tell that there is an element of business risk? By evaluating these 4 components. I will evaluate the financial risk, operational risk, compliance risk, and external risk. Now, under financial risk, there are some factors that I need to evaluate, or there are some indicators that I need to see and make my personal conclusion that there is possibility of a financial risk. Meaning, when I'm working on financial risk, there are those issues that I'm interested in. There's something that I've noted. I've realized that these people, I've just noted that these people, they are unable to pay their employees. These people, they are unable to pay their employees. Meaning, for the last 3 months, employees are want a new one. That should help me to understand there is a financial risk. Meaning, there is a problem. If these people are able to pay their employees on a monthly basis, that should help me to start thinking of there is a problem or issues of finance. Number 2, if I calculate the gearing ratio, meaning I've calculated the gearing ratio, and I've realized that these people, they are highly financed more by debt compared to equity. Now, that tells me there is a problem financial related. I do acidity test. I do my acidity test, and I realize that the current assets of this organization, they can't afford to pay the current assets of this organization, they cannot afford to pay their current liability twice. That tells me there is a problem. Now, if I realize that these people, they are unable to negotiate, for new loan agreement. Now, that shows me there is a problem. Now, if there are some issues that led to the environment where I'm operating in, because kuna change of rate. Now, we are talking of dollars increasing in value. I'm talking of maybe interest rate changing. All these indicators, if they affect the business negatively, then I conclude that this is a financial risk. Meaning, financial risk, I need to work on issues that relate to issues of finances within an organization. If you check on what we wrote in your notes, we are talking of failure to renegotiate for a new loan agreement. Now, in the first place, you are looking for a loan. That tells you you have a problem. Now, if I had a loan that I was servicing as an organization, and I want to get an additional loan, or maybe I want an overdraft facility, is a good indication that there could be a problem that led to issues of finance. I also remember we noted that increased interest rate. Now, before the beginning of this year, interest rate were going around 14%, 15%. Now, currently we are talking of interest skyrocketing to 18, 19, 12%, depending on the industry. I mean, depending on the institution, meaning it's a good indication that there could be a financial issue. Meaning, for examination reasons, when you are evaluating financial risk, you need to see some of the indicators that touches on issues of finance, asset ratio, issues of gearing ratio, unable to pay your employees, unable to pay suppliers, unable to manage day-to-day operations because of lack of cash, is a good indication of financial risk. Number two, operational risk. Now, when you talk of operational risk, and there's something I'll show you. When you talk of operational risk, this refers to a risk that is within the management control. I want you to know that in. Meaning operational risk is any risk that is likely to arise, and this risk is within the management control, meaning you make your decision differently and you are off the hook. If you are working with this organization and I've realized that their internal control system, they are weak. Now, internal control system, this refers to financial and non-financial controls within an organization. That is coming. Internal control system, this refers to policies and procedures within an organization. Financial and non-financial controls. I've given you two definitions, somebody. So what is internal control system? This can be policies and procedures within an organization. We can say this refers to financial and non-financial controls within an organization. So if this internal control system of the organization, they are weak. Now, that should help me to understand there is an operational problem. Now, weak internal control system, it helps me to understand that the internal control system are not able to achieve the 5 objectives of ICS. Somebody listen to this. We have 5 objectives of ICS. Number one objective of ICS is to safeguard the company's assets. Number 2, another objective of ICS is to prevent and detect errors and fraud on an effective manner, on a timely basis. Number 3, another importance of internal control system is to ensure the policies of the organization are being adhered to consistently. Another important, number 5, is to ensure security and proper documentation of accounting record. The number 5, that was number 4. Number 5 is to ensure that the company achieves its objective. Listen to this. We are saying we have 5 objectives for ICS. Safeguarding the company's assets, to prevent and detect errors and fraud, to ensure that the policies of the organization are being adhered to consistently, to ensure that the company achieves its objective, and number 5, to ensure security and proper documentation. Meaning, when we are developing internal control system, that's what we are trying to mitigate. But if the ICS are weak, that means someone can steal from the organization, somebody can defraud the organization. The policies are likely not to be adhered to consistently. Meaning, as an auditor, when you're evaluating this organization and you realize that they are weak internal control system, that should help you to understand there is a problem. Other issue that you need to evaluate, you are evaluating this organization and you realize that they don't have internal control system. Meaning, you also need to understand as an auditor, how will I tell that this internal control system are weak? I can only confirm that this internal control system they are weak if I evaluate the component of ICS and I realize that this component of ICS have not been properly structured, or I realize that this internal control system are not efficient and effective, that will help me to understand there is an issue. Meaning an operational issue, one of the factors I need to consider is what about the internal control system? Are they weak or are they strong? If they are weak, then I know there is a problem. If they are strong, then I think that's okay. Now, during internal control system discussion, of course, I'll show you how to audit internal control system. Yes, I'll teach you mute kindly. Yes, must do something. So during our internal control system, I'll teach you how to audit internal control system. I'll have to show you how to do it. Number two, other than just understanding how to do it, you need to understand how to do an evaluation. I remember some point in our previous discussion, I was talking about issues of ICQ and ICEQ. Now, this is about evaluation of internal control system. So if I evaluate this internal control system and I know that they are weak, then I'll conclude there is an operational problem or operational risk. Number two, I can confirm there is an operational risk if I realize that these people, they don't do research and development. Meaning, if the business is doing fine, of course, we see that whatever brought us here will not take us there. That's about issues of investment, meaning the idea, the knowledge that brought me here will not take me to the next level. Meaning, the products that you initiated in your business, you introduce to your customer, know that tastes and preferences keep on changing. Meaning, if you don't do research and development, then it means customers are likely to change and go for a different product, and yet you're still supplying the same product. Meaning, if you don't do research and development, then now that is a good indication there will be a problem under operational. Now, if I'm dealing with this organization and then I'm evaluating the structure of this organization, then I note there is high management turnover. Meaning every year somebody has to resign. Last year they had a different CEO. This year they have a new CEO. That is a good indication that this could be an operational issue. Note this. Every time when there is high management turnover, people leaving the organization, a gap is created. Now, once this gap is created, someone is likely to take advantage of that and defraud the organization. Remember, the top management, they formulate policies. And now we are saying under ICS, those policies are supposed to be adhered to consistently. Now, if there is high management turnover, then it means a gap is created and somebody can take advantage and defraud the internal control system. Meaning, I'm evaluating this organization and the realize there is high management turnover. That should help me to understand there is an operational risk. If you realize that these people, they are overtrading, they are over-relying on one product. These people, they don't do diversification. They are over-relying on one product. That should help you to understand there is a problem that touches on operational issue. Now, you realize that yes, they have management, but they don't have board of directors. They just have one director who is over domineering. And dominant CEO brings in element of inherent risk. We'll discuss that. Meaning, if I note as an auditor that they are depending on one over domineering MD, CEO, that should help me to understand there is an issue that touches on operational matters. Number next, compliance risk. Now, compliance risk, now this is about issues of policy. Now, something else I need to indicate before I go to compliance risk. Now, financial risk and operational risk, all these two, they are within the management control. Note this, financial risk and operational risk, all the two are within the management control. What does it mean to you? It means it is up to the management to work on themselves to address the issue of financial and operational issue. Meaning, if the internal control system they are weak, we are supposed to improve them. If there is high management turnover or high staff turnover, then we need to see what is causing that dissatisfaction and address that. Is it maybe issues of salary or remuneration or something? And we address that problem. If it's a financial risk that is there, then it means I can renegotiate with my creditors for period extension so that I can address those problems. I can also talk to the suppliers of this organization that yes, you supply to me, but extend the due date, the time that I'm supposed to be paying you. But when it comes to compliance and external risk, the two are not within the management control. Now, how will we tell that there is compliance risk? Now, number one, if the government changes the policy that affect that organization, be that industry, negatively. Now, that should help you to understand there is an issue. Now, let's think of maybe tax. These people that we pay tax, corporate tax of 30%. Now, someone introduces additional tax. There's nothing you can do about it other than comply with what the government has decided. Meaning, it's a good indication there is a compliance risk. If I look at this organization and you realize that these people, they don't meet the obligation that has been set. Meaning there are some policies, maybe there are some environmental license that you're supposed to have. You're supposed maybe to have an operating certificate you don't have. Now, that is an issue of non-compliance, meaning there is nothing you can do about it other than just complying, otherwise your license will be withdrawn. You are entering this organization and you realize that they don't adhere to ISO certification. ISO certification means they don't ensure quality of their good. If you don't ensure ISO certification of your product, then it means you are going to comply with the set regulatory framework. KEMSA is there. They're supposed to ensure that there is quality of good, and you don't ensure all those goods they are being certified. Is a good indication that there is a compliance. Meaning, compliance risk, any risk that is emanating with issues of policy formulation and addressing issues of policy organization. Then finally, we have external risk. External risk, again, this is a risk that is not within the management control. It's a risk that is not within the management control. And if it takes place, there's nothing you can do about it. Now, a good example is change in technology. Change in technology. If technology changes, it's either you change the technology or you're out of the market. Meaning, if the technology changes, that is a good indicator of external risk. Any calamity, issue, maybe fire, maybe floods taking place, that will affect your business negatively, and there's nothing you can do about it. Meaning, it's an external risk, that you need to address. Now, there is a stiff competition. Somebody somewhere has just decided to open a supermarket next to your kiosk. The competition then becomes stiff, meaning it's external risk. There's nothing you can do about it if somebody decides to open a new business next to your door. It's either you just learn how to live with that person, meaning any change of any factor that you cannot address at your level, all those issues relate to an external risk. There's an introduction maybe of attitude, public opinion, and attitude. People are feeling different about some products. Initially, we used to have polythene bags. Nowadays, you're talking of wood bags. And now you can't operate without those wood bags. If you're caught with those other polythene bags, then a decision or maybe an issue, a legal framework is like to be taken against you. Meaning, if there is any external factor, any calamity, any change in technology that takes place, that is likely to affect you as an author, although those factors result to a business risk. Remember, why is this important to you as an author? The information that we have given here, it will help me, number one, to understand which is the right technique that I'm supposed to use to gather sufficient appropriate evidence. Number two, this will help me to understand the audit approach that we can use when you're auditing such organization. And number three, this information will help you to understand issues of materiality level that you're supposed to set. Meaning the information that you're given there, other than just issue a passing exam, you also need to understand how this is likely to affect you as an auditor when you are doing your audit assignment. As long as you have evaluated the element of business risk, now this will help you to understand which is the right audit procedure that we can use. Somebody can do analysis, another person can do analytical review procedure, somebody else can do performance, somebody else can do circularization. But for you to make a decision on which technique to use, you must have had a background check on some of the issues like now business risk, meaning Business risk will help you to understand the approach that you're going to use, your maturity level. It is going to help you to understand the audit approach that you're supposed to use when you are gathering evidence. Then something else we need to know. Mitigation process. Remember, under other incidental activities, as our topic 2, we were discussing objective or not and duties of another, and I think I need to engage you in this part. Now I want to talk to who? Where is I want to talk to who? Isabella, can you hear me?
Yes, please.
Thank you. Talk to me, ma'am. What is the objective of an auditor? I will help you. You just need to start, then I'll help you. Isabella, what is your main objective as an auditor? That is topic 2.
Okay, this is my first lesson.
Oh, it's your first lesson.
Yes.
Welcome, ma'am. Welcome. Can you pick anybody of your choice? I know you're able to see your colleague, anybody of your choice. And I have present for you, Isabella. Yes, make sure that you engage me. I facilitate on how you can get topic 1 up to topic 3. I think I had something here that I prepared for Vincent, and I think I can share with you. And maybe another person who feels maybe has some gaps. But it's not that someone tried to convince me and he gave me 5 reasons why I should do so, and I had to do it anyway. Section 4E class, and I said, yes, I'm going to do that. So Isabella, I think I can facilitate you, and if maybe I don't do so, Vincent, I hope you are listening. You can also share with what I sent to you in your group so that another person can just try to see what we did. Now, unfortunately, yes, Vincent. I will share. Yes, please do so. Please do so. And if you can get the video again, that's better, because the content that I give you in class might be a bit different from what you have in your notes. In our class session, I do combine both practical and also the coursework. So it's very important also you have the topics, the videos, so that it can help you to understand, especially on how to answer some questions and also the purpose of practicing. My purpose and my intention is to make sure that not only you guys you understand the past exam, but I also try to help you to understand. At your level now, you should be doing issues of audit assistant. I think we did audit planning memo, and there is something I told you about staffing arrangement. So at least when you be doing your audit assignment, using those videos can help you to understand some of the issues that you're supposed to be working on. Now, Isabella, I want to give this privilege. Pick anybody of your choice and to be objective of an answer.
Mercy.
Yes, Mercy, I hope you umesikia si mimi nimekusema. So Mercy, very fast, tell us, what is the objective of an auditor?
Mwalimu was not present in that class, but I can give my own.
Oh my goodness, my goodness. So who was there? So pick anybody of your choice, Mercy. Anybody of your choice to be objective of an auditor.
Vincent.
Vincent, bro, talk to me. What is your objective as an auditor? Ayo, Vincent utaniambia na wewe haukokuwa.
Nilikuwa wacha nijaribu.
Now listen someone. The objective.
Wacha nimsaidie.
Yes.
Objective of an auditor is to express an opinion whether financial statements are prepared
in normative respect and they reflect to
in accordance with the financial reporting framework.
Exactly. So, in a summary way, when someone asks you about objective or not, tell this person that objective of an auditor is to express an opinion that the books of account reflect to and fair view. I repeat, the objective of an auditor is to express an opinion that the books of account reflect to and fair view. Please, you might forget everything else, but please don't forget the objective of an auditor. Because when we discussing topic 8, our last topic, after we are done matters and ISQC1, we'll be discussing forming an opinion. And the same information that we worked on in our topic 2, we'll be linking that information with what we'll be discussing then, just to help us to understand our syllabus so well. Please, our main objective as on task is to express an opinion that the books are going to reflect to and help. Then with that understanding, before you express an opinion, we said we have some duties, some responsibilities, some matters under the 7th schedule. I'm looking for something now. Other than just before you express an opinion, there are some activities that you must perform. There are some duties. You have some responsibility. And I think I should be talking to Annette. Annette, what are those matters under the 7th schedule? Duties of an auditor. Please give us 2. Annette, you can't afford to go silent. Now, Shadrach, talk to me, bro. Duties stroke responsibilities of an auditor. Shadi, can you hear me?
Yes, I can hear you, but
So,
I'm in transit.
yes,
You'll forgive me, but I can give one. The
you can give one.
One of the duties of an auditor is to examine the books of an entity.
Is to
examine the books. I'm not quite sure about this.
But you're doing fine. You are doing fine. It's okay. You are doing fine.
Yes. One of the responsibilities is to examine the books of an entity to express a fair view.
Okay. Now, this is what I want us to do, my good people. We will be planning for a class whereby I'll be doing a review. Of course, after we are done with the syllabus, I'll do a review from topic 1 up to topic 2 on one session. I'll be taking you through all these topics from topic 1, topic 2 up to the last topic. But as we continue, I tend to believe maybe some of you were not there when we were doing our introduction part, issues of topic 1 and probably topic 2 and maybe part of topic 3. So I think within the week, if I get a slot somewhere, I think we need to have a discussion so that if you miss, I can just do a quick review. Meanwhile, of course, Vincent has promised to do something. He'll be sharing those notes with you. Just read them. See, somebody to come a storybook. Then when I can decide, I'll just take you through the 3 topics just to help you to understand what we need. Because the information that we have in topic 1 up to topic 3, they are very important areas that we need to understand. And of course, I told you from topic 4, now going forward is now when we start doing our audit assignment. And I did understand that in the current topic we accepted an engagement and we raised an engagement letter. We did our planning process and we started auditing. Now, this far we are trying to do an evaluation. And of course, I'll show you how this information is likely to affect you. So it's very important for you to know this. Now, for purpose of today's session, our main objective here is to express an opinion that the books are going to reflect to and fairly. But before you do that, there are some duties and responsibilities, matters at the 7th schedule that you are supposed to perform. Number 1, is your business in order to confirm whether the company has kept proper books of account. That is your assignment. Number 1, check whether the company has kept proper books of account. Number 2, check whether you have received all information and explanation deemed necessary for the purpose of forming an opinion. Meaning you have a responsibility to confirm whether you have received all information and explanation deemed necessary for the purpose of forming an opinion. And of course, I'll show you the purpose of that in our next topic, that is topic 5. Next, you have a business to confirm whether the policies of the organization has been adhered to two, consistent, meaning we have a business to confirm whether the policies organization has been adhered to consistently. Then number next, we have a business to confirm whether the financial statements are in agreement with other books of account, including receiving returns from the branches that never visited. I repeat this. We have a duty to confirm whether the financial statements are in agreement with the other books of account, including receiving returns from the branches that never visited. Then number 5, we have a duty to confirm whether the books of account, the financial statement reflects true and fair view. Listen somebody. The examiner will ask you the primary responsibilities of an auditor, or the examiner will ask you the duties of an auditor, or the examiner will ask you matters under the 7th schedule. It's the same answer. Now, other than this primary responsibility, we said we have other incidental activities that you can perform you as an auditor. Number 1, we said as an auditor, you can advise the management. And number 2, you can prevent and detect errors and fraud. Please announcement somebody. We said those are other activities, other responsibilities, other activities that you can perform. Please, those 2 points that I've given you, those are not primary responsibilities of another. Those are other incidental activities that you can perform. So, okay, this is our example. This is responsibility of another. Please, Isabella usiniambie prevention and detection of errors and fraud, and don't tell me to advise the management. Those are other incidental. Ukiona umeandikiwa other incidental activities, now you can give those 2. Now, listen to this. We have said, as an auditor, when you assess possibility of business risk, remember, we said business risk, this refers to any event or activity that is likely to take place and affect the business negatively, hence affecting the going concern of the business. Now, if you know this business risk, then you can perform other incidental activity. 1, you can advise the management through management letter. Now, what will you be advising them on? Mitigation process. So, other than just understand the components of business risk, number 2, we need to understand what are the mitigating factors. How do we mitigate financial risk? How do we mitigate operational risk? How do we mitigate compliance risk? How do we mitigate external risk? Now, listen somebody. We need to teach ourselves the simplest way we can pass exam without struggling. You don't need to spend 8 hours because kulala to try to understand the components of business risk and how to prevent them. It's just a matter of resonating the simple activities that they happen within the environment. Now, if I know there is financial risk, I've done my Z-score and I've realized it's below 0.86. That tells me there's a financial distress. I repeat something. You've done your Z-score and you've realized that this company has financial distress. Then it means to you as an auditor that these people, they are struggling. So chances are, number 1, they are not able to pay their employees. Number 2, they are not able to pay their suppliers. Their city ratio is not 1 ratio or 1:2, and of course their gearing ratio is very high. So how do you mitigate that? Number 1, they can negotiate with their bankers to extend their period. They can renegotiate with their suppliers. They can renegotiate with their clients. If they have some professional they're supposed to pay, they can renegotiate. Meaning, if they have some debt, they can negotiate with the bank for loan extension. Now, if it's an operational risk, if the internal control system, they are weak, that means obviously I need to work on the internal control system. I need to improve on the internal control system of this organization. Announcement. Internal control system is another highly tested area in our level. So please, of course, I'll be preparing something so nice for you on errors and fraud. And please, I want to make this very clear. Ukishapata hizo notes, because I'm going to do something. Please keep that part of errors and help so well for me, because it is highly tested in our section, that is our intermediate level, and of course at advanced level. But at advanced level, that is not part of our coursework. Meaning, to keep pattern advanced level, section 6, I will not teach you on internal control systems, but that area is highly tested. Meaning, whatever I'll be teaching you now on errors and on internal control system, the same information needed in your next level. Please make sure that those notes, you keep them well. Now, listen sample. If I've noted that the internal control system, they are weak, meaning they cannot prevent detect errors and fraud, then I can develop the internal control system. I can improve on the internal control system. I can work on the components of the internal control system to make sure they work. If there is high management turnover or high staff turnover, people are leaving the organization. Then as management, what do I need to do? That means I need to understand what is causing this dissatisfaction. What is causing employees to leave the organization? Is it maybe issues of remuneration or something? If it's a matter of remuneration, then can I work on that? If we don't do research and development, then can we work on the research and development? Can we do some research? Can we try to do diversification of whatever we are selling? Meaning, if we are selling ice cream, then isifike mwezi wa saba and still tumekwamia hapo kwa ice cream. You are selling umbrella, and now imefika tu mwezi wa saba and you are still selling umbrella. Think of something else. Can I bring something else that is inversely related to whatever I'm selling, so that at least I can remain in business? If you know you are over trading, that means you need to see, you need to include more products that you are selling. You need to introduce more products so that you can at least maintain the customer's taste and preferences. If the issues of compliance matters of compliance, that means if I don't have operating certificate, please look for one. If I'm supposed to have an environmental license, then I need to look for one. Meaning, under compliance issue, then I just need to ensure that I comply with what government requires of me. If it's an external factor, number one, I can do nothing and hope for the best. Meaning, there are some risks that I have to take place, and there's nothing you can do about them. You can do nothing. You can do nothing and hope for the best. If it's about issues, you can also insure your business against these calamities. Take insurance cover. You're trying to spread the risk. You're trying to spread the risk, etc. Meaning, the examiner asks you, what are the 4 components of business risk? And of course, I will ask you about mitigation factors. How do you mitigate business risk? Please note what you have just said. You can use just one, try to see how you can work on that. You go to the next, try to see what you can work. Compliance, kila moja kivyake. Or maybe you can just go by what I gave you in your notes. You try to see the points that I gave you. Now, listen something. It's one thing understanding components of business risk. It's another thing understanding mitigating, and it's another thing understanding what is business risk. But now, for you as an auditor, what does it mean to you? Now, listen, some of this is very important. You as an auditor, when you realize there is business risk, then what do you need to do? I'm an auditor. You may evaluate your organization. They can realize you guys this element of business risk. Then what do I need to do? Now, if there is any possibility of business risk, then I need to understand what is the effect of business risk. What's the effect of business risk to the financial statement? I repeat, and please listen keenly. I've evaluated the business risk. I've noted this element of business risk. Now, the next question that I need to ask myself, what is the effect of business risk to financial statement? When you see these questions, I'm going to ask you, what's the relationship between financial statement risk and business risk? That's a question that is highly interested. Now, effect of business risk, number one, if there is any possibility of business risk, then expect that the income statement and the balance sheet, all these are materially misstated. Meaning, how are they misstated? Point one. So, this one effect of business to financial statement. Number one, the income stroke revenue and the assets are likely to be overstated. Somebody, I hope you're listening. Meaning, effects of business risk to financial statement. Number one, the income and the revenue of this organization, they are likely to be overstated. Very important point. Together the evidence. Meaning, nikipata last year 2022, 2020, maybe 2021, 2022, or maybe 2022, 2023. If I realize that you have told me 2022, 2023, our profit is 50 million. And last year, the profit was 45 million. Immediately, as an auditor, you need to develop element of professional skepticism that something is likely to be wrong. The 50 million that you are seeing is likely to be overstated. If it is the financial position, that is the balance sheet, then expect ukipata umepewa assets, ukaambiwa assets worth 65 million total assets. Note that those assets are likely to be overstated. Meaning it is your duty as an auditor to gather sufficient appropriate evidence to confirm whether this 50 million is overstated and these assets of worth 65 million are likely to be overstated. Now, the next question that you need to ask yourself is how? Meaning, when I'll be auditing, I need to understand how can they overstate the value of assets? Number one, I know they can change the provision. I know they can change the provision on doubtful debt. They can also change the provision on depreciation charge. Meaning, if somebody wants on depreciation charge in a negative way, then it means it will reduce the depreciation charge. At the same time, the value of assets are likely to be overstated. Meaning, that introduces us number two, effect of business risk to financial statement. Number two, the expenses and the revenue, not revenue, the expenses and the liabilities are likely to be suppressed. Meaning, when we working on assumptions, expect the expenses that you have been given there, all the liabilities, they are likely to be omitted. Now, meaning, if I increase the value of revenue and I reduce the value of expenses, then it means the profit there is overstated. So the part this year we made a profit of 20 million. Really, chances are that profit is overstated. And if the profit is overstated, then it means the balance sheet will also be overstated because of the reserve, and cash equivalent will also be overstated. Now, that's what we call perfunctory. That's what when we forming an opinion, we'll be confirming an item that's material and perfunctory. Then from there, of course, try to see how to qualify the report by that factor. Meaning, if I go through the organization and I've realized that there is element of business risk, then back in my books of accounts, nikipewa hiyo kitabu tu hizo financial statement, the revenue I will know it is overstated and the expenses are like to be suppressed. If I go to the balance sheet, I expect the assets are like to be overstated and the liabilities are like to be suppressed. Number three, possibility of errors and fraud. Possibility of errors and fraud. As long as you have noted that there is an element of business risk, remember, chances are somebody somewhere is likely to defraud the organization because there is a gap that was created somewhere because of operational risk, and someone took advantage of that gap and defrauded the organization. So if you appreciate this element of business risk and an auditor, then you need to gather sufficient appropriate evidence to confirm is there a possibility of error and fraud within the financial system. Number 4, there is possibility that the policies of the organization will not be adhered to consistently. And please be careful of this term consistently. Meaning every time, if there is element of business risk, then expect the policies of the organization is likely, the policies of the organization are likely not to be adhered to consistent. And that's why when I'll be evaluating issues of provision, I'll be just to confirm to do what we call analytical review procedure, that is ARP. Analytical review procedure is whereby you go back to the previous books of account, you'll be interested on the relationship, changes over time, you'll be interested on moving averages, etc., etc. Meaning, by the fact that there is any business risk, then expect a possibility that the policies of organization will not be adhered to consistent. Then number 5, because of business risk, then there will be financial statement material misstatement. It's a sample. Because of business risk, then expect there will be financial statement material misstatement. Now, that's why that question I told you. If someone asks you what the difference between, or maybe the relationship or the correlation between financial statement risk and business risk. Somebody will also ask you the correlation between on risk and financial statement risk. All this you need to understand. 5 points that you should not look or forget as an auditor: effect of business risk. There will be financial statement material misstatement. There is possibility that the policy will not be adhered to consistently. There is possibility of errors and fraud. There is possibility that expenses and liability will be suppressed, and there is possibility that the income and the revenue will be overstated. Now, this is whereby the audit starts. So I'll be surprised if in quarter 2 sigmoja you are auditing, and the first thing you are rushing, you are going to the financial statement. I will question your integrity. I will question your competence in auditing. I expect you need to do some assessment at some point. Remember that those stages I took you. Remember we went through 11 stages. Stage 1 up to stage 4. We see these are the factors to consider before accepting an engagement. Listen, Isabella. We said we have factors to consider before accepting an engagement, whereby we were discussing legal statutory matters, we were discussing professional matters, we were discussing practical matters, and professional courtesy. Please, in your own time, get to understand what they mean to you. Then from there, we did client acceptance and raise an engagement letter, whereby we said engagement letter, this is a contractual document between you as an auditor and the management. Once it has been signed, it becomes binding. Then we did discuss the content and also the importance of those content there. Then from there, we worked with the background information, whereby we are trying to understand our client better in terms of their internal control system, the risks there, the location, the size of this organization. All that information helped us to come up with a strategy. So in your own time, try to understand what is a strategy and how do we formulate a strategy. As long as I know the practical matters, I know the number of subjects I have, I know the size of the client, then I'm able to tell the time that I'm going to spend, the number of subjects I'm going to engage to on that organization. That is a good example of a strategy. Please, in your own time, Isabella, work on that, try to understand how to formulate a strategy. Now, with this information, I've known that there is element of business risk. I've seen the effect of the business risk in the financial statement. The next question I ask myself then, which is the right audit approach that I can use. Now let's do this for the purpose of understanding. The purpose of understanding. I did tell you we have different types of approaches. Please somebody note somewhere, come on, comment somewhere, just note somewhere to help you in this assignment. Types of audit approaches. Types of audit approaches. Number one, we say we have system-based audit approach. Number two, we say we have balance sheet audit approach. Number three, we say we have analytical review procedure approach. Number four, we say we have substantive testing approach. Number five, we say we have test of details. Test of details approach. I hope your neighbor is following. And number six, we say we have risk. This is where I'm picking conversation from. Risk-based audit approach. Now, somebody listen. When we were planning, we said we plan on the time to spend, the number of staff to engage. We plan on the cost, audit techniques, audit approach, audit risk level, materiality level. Somebody, you have done an evaluation of business risk and you have noted that there is a business risk. How did I tell there is business risk? I evaluated the 4 components of business risk. Shadrach, do you remember components of business risk? Give us like 15. Shadrach alienda kuangalia news. Vincent, give us like 15. Oh, yes. Financial risk. Exactly. So please, somebody tell you. Yes. So somebody will tell you to do risk assessment. Now, risk assessment is whereby you are trying to confirm possibility of those 4 components in a statement that will be given. Meaning, somebody give you a subject matter. Out of that subject matter, you'll be expected to do risk assessment. Risk assessment is whereby you are trying to find out whether any of those 4 components are there. Now, if they are there, then back in your mind, somebody, you start thinking of the financial statement that they have given me for the purpose of audit. Because every time when you'll be auditing, you'll be given financial statement draft. You'll always conclude any of these 5 matters have taken place. With this information, then, you need to understand which is the right audit techniques that you can use and which is the right audit approach that you can use. Now, under different types of approaches that I've given you, which I believe some of you have noted them somewhere. If you have noted somewhere, note 6, we have talked of risk-based audit approach. Under risk audit approach, this is categorized into 2. Number 1, we have business risk approach. And number 2, we have audit risk approach. So in our conversation today, I want to see how does business risk audit approach works. You can grab this. And please, I hope neither to Pole, I want us to understand this area so well, so that when we start gathering evidence, we'll not have challenge yes, will not have challenge. So we have risk-based audit approach. Risk business risk audit approach. Now, under business risk audit approach, we call it a top-down audit approach. This is a top-down audit approach. Business risk approach is a top-down audit approach. And top-down audit approach, you start with the industry. Then from there, you go to the business. Then from there, you go to the management. And finally, to financial statement. So, business risk is a top-down audit approach, meaning you start from the industry, you narrow down to the business, to the management, and finally to the financial statement. Listen, if I did an evaluation of business risk and I've chosen to use risk-based audit approach for the purpose of gathering sufficient appropriate evidence, then when I'm using business risk audit approach, I need to start with the industry. Meaning, under the industry, I want to understand all the risks that are facing any other organization existing within that industry. Now, let's pick maybe a case study. Let's say we are auditing maybe KCB. Or maybe we are auditing maybe Equity. Or maybe any organization of your choice. Pick the organization where you work in. Now, assuming you are auditing KCB, before you start auditing KCB, number one, evaluate within that industry what are some of the risks that are likely to affect any other organization that is existing within that industry. Meaning, I know in commercial institution, we can be affected by fiscal policies. We can be affected by monetary policies. So meaning all these affect across board. Meaning the same way KCB will be affected by interest rates is the same way equity will be affected by those rates. The same way KCB will be affected by increase in the strengthening of dollar compared to shilling, the same way equity will be affected. If there is political unrest, that will affect KCB the same way equity will be affected. Meaning, under top-down audit approach, you start by evaluating the industry to understand what are some of the risks affecting any other organization that is existing within that industry. Then from there, once you have worked on that, you narrow down to the business, whereby under business, you are interested to confirm this specific organization that I'm auditing KCB. What is this specific problem, the specific risk that they are facing? Maybe they have operational issue whereby they have weak internal control system. Maybe they have some financial issue. They are unable to issue new loans. They are unable to pay their employees. They are unable to do research and development, etc., etc. So I'm interested to confirm under the problem that are affecting any other person. What are these specific problems that you are going through? Meaning, I'm interested on that specific problem. So I want to confirm. You KCB as individual, as an entity, what are you going through? Are you able to pay? Do you have issues of non-compliance? Do you have some issues of operational risk? Do you have some issue on financial risk? Then once you've done so, you narrow down to the management, whereby you are interested on the decision that the management are making due to the fact that they have some business risk. Meaning at this point, you are interested. What are some of the decisions that you as management you are making that are affecting this organization or as a result of business risk? I repeat, after you've done an evaluation of business entirety, check What is the management decision? I know there is something that you're likely to do. They are likely to make some to make the business look attractive. Remember, the management, they act on behalf of the stakeholders. As management, you are being engaged by, maybe you're being engaged by the shareholders to do that job. So as management, as board of directors, you are being paid to make sure the company is doing well. Somebody has invested or somebody is planning to invest in that company. So you, as management, you have to make us feel that the company is doing well. And because of that, somebody will misstate the books of account so that they can reflect profit. What does it mean to you? If you reflect profit that is not there, then know that number one, you'll be forced to pay dividends. Number two, because you have reflected profit that is not there, you'll be expected to pay taxes. And because you have a shortfall, then you'll be forced either to sell the company's assets, or probably you'll be forced to take a loan to finance those dividends and taxes. Now, that's what we call knitting. So ukisikia mtu amesema knitting, just know knitting is whereby somebody is selling company's assets, somebody is trying to borrow money to finance debts and taxes. That is not acceptable. Meaning, you make the company look attractive when in actual sense they were not doing well. They were making losses, but you turn those losses into profit. And by the fact that you reflect profit, you'll be expected to pay dividends, you'll be expected to pay those taxes. Meaning, after you have done an evaluation of the business risk, narrow down to the specific management to see what are they doing to make the company look attractive. Obviously, we have said they will do some makeup. What are funny, do some makeup. They want just everything to look perfect. When that says there's some issue. I'm talking about business risk. I'm talking about the organization. Management trying to do what? To make some makeup. Now, listen. Out of management decision, from there, you need to check. Out of the management decision, what is the effect of the management decision to the financial statement? We started the industry, we narrowed down to the business, we went to management, and finally we are trying to see what is the effect of the business to the financial statement. Is there a possibility of financial statement, material statement? Is there a possibility that the revenue and the assets are overstated? Is there a possibility that the expenses and the liabilities are suppressed? Is there a possibility of errors and fraud? Is there a possibility that the policies are not being adhered to consistently? I'm trying to confirm effect of business risk to the financial statement. Meaning, with this information, I will decide to use business risk audit approach, which is a top-down audit approach to help me to confirm this. So in our topic 6, we'll be working on issues of assertions. And I think at this point, I want to make a commercial statement. To get over physical class, they can say how it should be as I make this a statement, but now because you are into a comfort of your bed, listen. Tomorrow we will be discussing audit risk. Of course, I'll start today. I'll be introducing today. Please, you can't afford to miss. That is very, very important for you. Because once I'm done with business risk and audit risk, I'm torn in between two. Just dashing to the last topic to help you to understand how to form an opinion, or maybe go to the next topic trying to understand how to gather sufficient, appropriate evidence. I'm here to make up mind on where to go, but you can't afford to miss part of whatever will remain after you've worked on today. Now, before I go to audit risk, anybody who has an issue on business risk? 3 questions that I like to be tested in this level. I mean, in this subtopic. Number 1, somebody will ask you, define business risk. You are saying it is any event or activity that is likely to affect the business negatively, hence affecting the going concern of the business. Then somebody can ask you components of business risk. You have said you have 4 components: financial risk, operational risk, compliance risk, and external risk. Then the next question that we can ask you is about mitigation process. How do you mitigate those risks? Key part you need to understand. Listen to the question. I hope you gentlemen and ladies, you are perfect. You see one or two pieces of risk mitigation. You are there giving out answer. Listen. The examiner can just be narrow. Akulize how to mitigate financial risk, how to mitigate operational risk, how to mitigate compliance risk, how to mitigate external risk. You need to be specific. If the examiner does not narrow the question, is an open, then you can write anything. Then another question that can be tested is the advantages and disadvantages of business risk audit approach. Someone can tell you, define business risk audit approach. What I don't think can be tested is how to do risk assessment of business risk at this level. That will become in the next level. But in case it does, already I've told you how to do risk assessment. Any question before I go to on risk? Please kama kuna swali type hapo, nitaona. If you can talk, the better. And please, mjifunze kuniongelesha, mjifunze tu, you just frame a question and you ask me. Mjifunze this, you ask, you talk. So that at least we can resonate pamoja. Now I want us to go to audit risk. Audit risk. Audit risk. Let me see whether we have any question. Okay, no question, it's okay. You guys, you are good student, you are very smart. Mnashikia kila kitu kwa ubao, speed. Congratulations. Now, this is all about you as an auditor. Business risk, we were just discussing about the organization, has walking into the organization, and before we start auditing, we evaluate some matters that can help us to make a decision, to help us to gather sufficient appropriate evidence. Now, when it comes to audit risk, it is a possibility that an auditor is likely to express an inappropriate audit opinion that the company has kept proper books of account when they have not done so, that the policies of the organization has been adhered consistently, when NATO says that is not the case. And number three, that the books of account reflect true and fair view, when NATO says that is not the case. Listen, somebody. On risk, it is the possibility that you as an auditor, you are likely to express an inappropriate audit opinion. That the company has kept proper books of account when NATO says they have not done so. That the policies of the organization have been adhered to consistently when NATO says that is not the case, and that the financial statement reflects true and fair view when NATO says that is not the case. Now, we have three components of audit risk. Components of audit risk. We have three components of audit risk. Number one, we have inherent risk. Number two, we have control risk. And number three, we have detection risk. Three components of audit risk: inherent risk, control risk, and detection risk. So we say audit risk. Actually, this one I need to bring it here. This I'm taking my time this area because it's a big deal all together. We say audit risk is equals to inherent risk times control risk times detection risk. Audit risk is equals to inherent risk. Yes, the first we say is inherent risk. Yes, inherent risk, control risk, and detection risk. Isabella, inherent risk, control risk, and detection risk. So we have said all risk is equals to inherent risk, control risk, and detection risk. Remember, we say all risk, it is the possibility that an auditor is likely to express inappropriate audit opinion. What is likely to cause that? Possibility of inherent risk, control risk, and detection risk. Now, when we talk of inherent risk, I'm going to give you two definitions of inherent risk. When we talk of inherent risk, we say inherent risk, this refers to the possibility of a material misstatement in the financial statement, either individually or when aggregated with other material misstatements in other classes, assuming there were no related internal control system. Listen to that definition, very important. Inherent risk, it is the possibility or the susceptibility of a material misstatement, either individually or when aggregate the other material misstatement, assuming there were no related internal control system. That is the first definition. Another definition, either because of nature of management, because of nature of engagement, because of nature of transactions, or because of nature of industry, a material misstatement is likely to occur in the financial statement. Listen, someone. The first definition, we say the possibility of material misstatement in the financial statement, either individually or when aggregated with other material misstatement, assuming there were no related internal control system. Another definition, we are saying the possibility of material misstatement in the financial statement, either because of the nature of management, meaning management characteristics, or because of the nature of engagement, that is engagement characteristics, or because of the nature of transaction, that is transaction characteristics, or because of the nature of industry, a material misstatement is likely to occur in the financial statement. A very important definition. Meaning, when you are doing assessment of audit risk, you need to assess possibility of inherent risk, possibility of control risk, and possibility of detection risk. Now, I want us to start by doing assessment of inherent risk. How will I tell that there is possibility of inherent risk? Now, let's understand inherent risk. When something is inherent, is something that is inseparable, meaning you can't separate that thing from the other thing. Meaning there are those things, like now, there are some risks in business that you can't separate them as long as you are doing that business. That risk is inherent, meaning inherent risk is that risk that you can't separate. As long as you are in business, it has to be there. Now, what is like to cause those risks? Either it can be either because of management, meaning management characteristics, either because of nature of engagement, transaction, or the industry where we are operating in, or the industry where we are operating in. Now, let's start with part one, the nature of management. Now, under nature of management or management characteristics, this is whereby we are evaluating some factors that are likely to cause us to believe there is possibility of inherent risk. Now, like I'm watching this organization, and I'm so much concerned about the management operating style, meaning the nature of management operating style, how they operate. Like now, if you are at this organization and you realize that they do not have supervisory board, meaning there is no board of directors, then that tells you there is a problem. There is possibility of inherent risk. If they don't have supervisory board, then it means the director makes decision and he is final. Meaning he can take money and use that money and nobody can question that person. Or he can make a decision and nobody can change that decision. If you're not in such organization, because of that nature of management, then you need to understand there is possibility of inherent risk. Or you realize that the nature of this management, they are over domineering, meaning they are coercive, meaning they make decision alone. That should help you to understand this possibility of inherent risk. Meaning, when I'm working on inherent risk, welcome Annette. I was so much worried about you, Annette, because now this area we work is very, very important, and now I can see you are on and off. Thank God this final you are here. We are working on components of on risk. We are done with components of business risk. Now, yes, I can see you have a network issue, but it's still okay. Yes, the Bible tells us, mateso ya mwenye haki ni mingi, but God will see us all through. Yes, so be encouraged, Annette. It shall be well. It shall be well, Annette. So, and when you are evaluating, now this is for you, Annette. Annette, we have said we have three components of out risk: inherent risk, control risk, and detection risk. Now, we have said inherent risk, it is a possibility or the susceptibility that there will be a material misstatement in the financial statement, either individually or when you get the material misstatement, assuming there were no related internal control system. Another definition we are saying, inherent risk would be possibility of material misstatement in the financial statement because of the nature of management, nature of engagement, nature of transaction, or the nature of industry. Now, for examination purpose, somebody will tell you do risk assessment. When you are doing this assessment, it's whereby you are trying to find out any connection with all these 4 factors that can help you to understand this element of inherent risk. So we have nature of management. How do we tell that nature of management can cause us to believe there is element of inherent risk? The first point we have said, in case we are dealing with the directors who do not have supervisory board, meaning there is no board of director. It's an organization that is run by one director. Now that tells you, ukajipata una own this a private company, individual business, there is a problem. What's the problem? This person makes decision alone. That is an indication of inherent risk. Now you are onto this organization and you realize that the management is coercive. Coercive, it means this person makes decision alone. This person is over domineering. That tells you there is possibility of inherent risk because of the nature of management. Another issue that you can work on, if you realize that these people, they, according to the nature of management, they have decentralized form of governance. If they have decentralized form of governance, then now that should help you to understand this high inherent risk. We have 2 types of governance. You can have either centralized or decentralized. Now, centralized is whereby all the decisions are made at one central point. But decentralized is whereby we have so many centers of power. Meaning, if I'm on organization and I realize I'm dealing with a group audit. Now, group audit, that will do it in the next level, that is in section 6. But for purpose of understanding group audits, you can have subsidiary, you can have maybe joint venture, you can have associate, you can have etc, etc, etc. If your organization which has several branches, wakona branch A, maybe moja iko Nairobi, ingine Mombasa, ingine Kisumu, ingine maybe a different country. Now, that should help you to understand that is a decentralized form of governance. Now, decentralized form of governance poses a possibility of high inherent risk because there are many centers of power and every power they make their own decision. That should help you to understand this element of inherent risk. So, the organization that you're dealing with, they have a centralized form of governance, you'll appreciate that there is a low inherent risk. If you're told they have a decentralized form of governance, that should help you to understand this high inherent risk. Now, another thing that you need to understand, you're evaluating this organization and you are told that these people, their remuneration is based on bottom line. Meaning, they are working under performance. You make more profits, you take more money home. Just know that there is high inherent risk. If you are told that the package, the take-home package is based on bottom line, is based on performance, as an auditor, you need to conclude there could be possibility of high inherent risk because of that factor. If I know I'm supposed to make more profit during the pesa mingi, then it means I will overstate the financial statement so that I can have more money, meaning there'll be possibility of material misstatement because of that. So I need to confirm any possibility that there is any remuneration that is based on performance or bottom line. If that is there, that should help you to understand there is high inherent risk because of the nature of management. Another item at the nature of management, you realize that there is high management turnover. Meaning, every time people are leaving the organization, every time these people are leaving the organization, MD anakuja leo, anakaa 3 weeks, and resign. Another comes in, stays for 1 year, he resigns. Another person comes and stays for some period, he resigns. Why are they resigning? There's a problem. Every time as they resign, there is a gap that is created. Now, someone will take advantage of that gap and defraud the organization. Meaning, because of that high management turnover, that should help you to understand there is possibility of inherent risk. Now, you are into this organization and you realize that you are dealing with the risk taker. Now, risk taker, it means This person is entrepreneurial. In the explanation scenario, somebody talk of entrepreneurial, somebody else will talk of risk taker. It's the same thing. So you are also this organization and you realize that the nature of management, these people, they are risk taker. They get an opportunity, they invest. Wanasikia kuna Eurobond wamenunua, wakisikia shares ziko wananunua. Another organization amefloat shares, kuna Bitcoin wako, kuna Bitcoin, they are still there. If these people, they are risk takers, they are entrepreneurs, that should help you to understand there is possibility of inner risk. So when I'll be evaluating these factors and I know they are there, I will conclude that inner risk is likely to be high. Now, you are dealing with these people who are so reserved, meaning they're not outgoing people. They don't change their policies regularly. The inner risk is likely to be low. But when you are dealing with these people and they're so aggressive, they keep on changing the policies, that should help you to understand this possibility of high inherent risk. Then finally, what about the reputation? Remember, when we are working on factors to consider before accepting an engagement, we say, let's communicate the previous auditor as a matter of professional courtesy. Now, when you are communicating the previous auditor, she will give you an inside information about, this person will give you an inside information about the integrity of the management. If the integrity of the management is questionable, that should help you to understand there is high inherent risk. And I think I'm done with the nature of management. So when you're evaluating nature of management, you evaluate those people, those items I've just mentioned. This person is once director, there is no supervisory board, their remuneration is based on bottom line, there is high management turnover, the remuneration is based on bottom line, the reputation is questionable, etc. Now, that should help you to understand there is high inherent risk because of the nature of management. Number two, nature of engagement. And the nature of engagement, if the question tells you it's your first time, actually, to get to the next level, that's why we start considering factors to consider before accepting engagement. When someone tells you you have been appointed, that means it's your first time. You have not entered this organization before, meaning you don't have history about the client. The only information that you have is the background information that you had when you were gathering information after accepting engagement. You have only the background information that you did. Now, that should help you to understand there is a problem by the fact that it's your first time engagement. So, okay, Skia, your first time, it is the first time, just not this high inherent risk because of it's your first time. Number two, if you have a specific reputation about the client, meaning you have negative impression about your client. Now, that should help you to understand there is a problem. Last year, you qualified the report. Last year, but one, you gave them an emphasis on matter paragraph. Last year, you qualified under limitation of scope. The other time you were auditing, you gave them an first opinion because of disagreement management. Already, you have a formal history about your client. There is something that now you are forming in your mind. Because of that history, that should help you to understand this nature of this high inherent risk because of what? The nature of engagement, because of the nature of engagement where you are operating in. You are operating this organization and you realize that you are not independent. Remember we say independence, this refers to a state of mind of being free and also being seen to be free. Now, lack of independence, then it means maybe you have some conflict of interest, this element of self-interest there. I hope you can remember Trust to Fundamental Principle, topic 3. Isabella, you have an assignment, topic 3. Now, you are auditing this organization and you know that your auditor's independence is compromised. You have been engaged in opinion shopping. I hope, Olivia, you can remember what is opinion shopping. Shadrach, I hope you can do so. Vincent, I hope you can remember. Annette, I hope you can remember what is opinion shopping. If you have been engaged in opinion shopping, then it means there is possibility of inherent risk. Number next, nature of transaction. You are auditing this organization and you realize that you are dealing with portable assets. Today morning you are counting money. Ulifika siku wanaambia wakupe save hesabu, on to realize they have got like 2 million, they don't have counting machine. You have to count everything. Utakuwa na hesabu ikifika 99 unaona maybe umekosea, una assume they are 100,000 when Nacho says they are 99 or maybe 98. By the fact that you are dealing with portable asset, there is high possibility of inherent risk. You are auditing this organization and you realize that those type of product that you are dealing with, you have to do some estimation. You have to make some assumption. That should help you to understand this high inherent risk because of what? The nature of transaction. Portable assets. That should help you to understand this possibility of inherent risk. Please note this. Under nature of transaction, you could be dealing with portable assets. You could be dealing with items that you need to do an estimation. Maybe you could be dealing with assumption. You are also a restaurant. Restaurants, they cook tea, they cook mandazi, they cook chapati, etc. You'll appreciate that when you're dealing with a restaurant, there's what we call portioning. Meaning you need to understand, once you're being given 1 kg of meat, that should give you 4 portions. You'll be given maybe 2 kgs of meat flour, that should give you 20 chapatis, that should give you 40 mandazis, that should give you 40 maybe samosas. Portioning. But remember, the same unga that you are doing 40 mandazis, somebody else can do 60. That chapati people are doing 20, you can decide to do 25. It's possible. What is affected here is the quality, meaning your cook can compromise quality and produce more. Meaning, by the fact that you are dealing with such type of transaction, that should help you to understand this high inherent risk. You need to make some estimation. Somebody add maybe 1 liter of milk, you're supposed to produce 8 portions of tea. But somebody can add more water and produce more, maybe to produce 12 cups, and compromise the quality. Now, in this tea, there are some tea leaves, there are some sugars there, meaning you need to do some estimation, the quality that were used and whatever is remaining. If somebody was doing maybe frying, there's some chips up ametengeneza, there's some maybe those cooking oil but often the quantity. You have maybe a half liter, not half liter, not 3/4. You have to make some estimation. Whatever is remaining to that, or maybe to that cookie, whatever, maybe it's not a liter, it's not maybe full, it's maybe half. You are just making an estimation. By the fact that you are doing some kind of transaction, that should help you to understand inherent risk is likely to be high. Nature of industry. This depends on where you are operating. The industry where you're operating in. Somebody is auditing a supermarket. Somebody else is auditing a commercial institution. Somebody else is auditing an insurance company. All those people, they work in a different industry. Different industry poses different business risk. Meaning, I need to appreciate by the fact that I'm operating within a given industry, there is possibility of a material misstatement by the fact that we exist in that industry. And by that fact, inherent risk is likely to be high. So in summary, when we doing risk assessment and inherent risk, you'll get some components here probably, others here, and others here. So finally, you'll appreciate inherent risk is likely to be high by the fact of because of those 4 factors, and you have just evaluated inherent risk. I think for today, we will stop there. Very important point. Please, in your own time, before we meet tomorrow, get time, just read through what I sent to you. Soma tu kama storybook na tupatane class. So that when I'll be explaining, at least you try now to conceptualize, is try to jog your memory, to try to understand whatever you read, what it means to you. So for today, we'll stop there. Allow me to take this opportunity to appreciate each and every one of you for finding time to come. I'm so excited when you keep time and when you are consistent all through. Annette, I'm really sorry you had some net problem, but I hope at least we may catch up in something. Please, tomorrow, remember, we are still meeting, I think, from 6. I believe you keep time so that at least we can finish this and try to see what else we can do. So for that, but we have gone. I wish you a lovely evening.